Yields rise amid fiscal concerns. The yield on the U.S. 10-year Treasury note climbed towards 4.55%, and the 30-year surpassed 5% for the first time since April. This move is in response to growing concerns over the U.S. fiscal outlook following the loss of the country's top-tier credit rating. Moody's downgraded the U.S. credit rating to AA1 from AAA, citing escalating government debt and widening budget deficits. And that's definitely a heavy message to read with your coffee on Monday morning, just as we get into the office. But let's talk a little bit about this and why U.S. stocks pretty much sold off, then bounced right back in response to this. We can see today gold is up, stocks are bouncing back, but pretty much flat on the day, and the dollar index continues to sink lower here in recent times. So first and foremost, we can talk a little bit about the US dollar, which took a hit off of this news because, of course, if the credit rating of the United States is weakening, that should most likely weaken the currency as well. But in my opinion, the downgrade here is a bit of a lagging indicator. We all kind of knew that the US national debt has been out of control. This is nothing new. And so this news really didn't surprise a lot of people. That's why we didn't get a massive move in markets. In fact, had this actually been a true surprise to the market, we probably would have seen the stock market down by more than, not even 1%. And I think that's also why the market snapped back all of its losses here to start out the day. However, the timing of this is tricky because now we have concerns about US national debt, and at the same time, we're seeing the dollar continue to push lower because trade uncertainty plus credit uncertainty equals challenges for the US dollar. And as I mentioned, yields are continuing to push higher because people are saying, hey, if we're going to lend money to the US government for bonds, we want better interest rates paid back to us because there's more risk now that the credit rating has deteriorated. Another winner in this has been gold. Take a look at gold on the daily chart, and you can see that we are continuing to hold strong at this upward trend line and now testing a level of resistance. In fact, I mentioned in our Telegram channel today that this is looking like a decision point for gold. I'm personally still neutral on gold. While the US economy is holding up okay and trade deals are looking a little bit more promising than a few weeks ago, uncertainty is still high, and whether you like him or not, Trump is a live wire. He has big things to say, big changes and things like that going on, which cause the market to be wobbly at times. I also mentioned that momentum on the weekly chart still favors the bulls here. And by the way, if you'd like to join our Telegram channel, it's completely free to join. I'm sharing charts each and every day. Join it using the link in the description down below. So as we analyze gold on the daily chart, like I said, we retested this long-term upward trend line, and buyers still seem strong, at least at these levels. I actually think that we're at a decision point here with gold, and if we do see some sort of recapture of this level of resistance that was once support, then that could signal that perhaps bulls are going to see a push back up to this previous high around 3,400 to 3,450. But in my opinion, it is a little bit of a bigger thing to ask for in terms of fresh all-time highs for gold at this time. As I mentioned, the US economy is holding up decently well. Just take a look at the unemployment rate in the United States, which remember that the long-term average is about 5.7%. 5.7% for visual reference is around this area here. So we are still at very low levels of unemployment, which is a positive thing for the state of the US economy. Following everything that we saw with the pandemic, the unemployment rate came down and has remained pretty steady for some time. And by the way, this number that we're looking at, this 4.2 or whatever percent unemployment rate that we're sitting at, this is why the world hasn't fallen apart. With all the inflation we saw following the COVID pandemic, we saw people really struggle at the grocery stores. But the truth is, the economies of the world were still growing and people were still employed. People being employed allows for the economy to soak in a lot of damage without having lasting effects. If we see this number dramatically rise, then you got serious problems. And when tariffs were scaring everyone, that was the concern. If we get a huge spike in tariffs around the world and it causes a massive amount of layoffs to occur because companies are readjusting for new prices and supply issues, yeah, that can cause some serious issue. And that was part of the bull case for gold during this huge up move that we saw back in April. But now developments seem a little bit more promising on the trade front, and so gold has normalized. I personally, again, remain neutral on this one simply because things are kind of hard to predict on that front right now. We don't see dramatic worsening in trade relations. We see some improvements there. And at the same time, the US economy looking a little stronger definitely puts a top in terms of gold, at least for the short term. However, technicals still heavily favor the bulls, and so I'm just neutral on this one. US oil is another one that I'm watching. It's getting a very bullish reading on the Edge Finder after considering sentiment, technical, and economic data with our top setups algorithm. Here's our oil chart on a daily chart. What you can see here is resistance holding up along this trend line. I'm very curious to see if we can get a breakout of this resistance point at 64. If we get this kind of move, this is a very high probability setup in my personal view based on my trading strategy. We have economic data supporting some strength globally, right? So some demand for oil on that front. And I do think that that could bolster prices to fresh highs here in recent months. We had a huge fall off with all the trade war uncertainties. If you get any announcements of deals, oil will likely rise higher as the demand settles in and is still valid. I think the concerns with oil have been, if we see a big trade war go across the world with the US and other places, the economies of the world might suffer. If the economies of the world suffer, the demand for oil might hurt. I personally am optimistic that deals will likely happen. And if those things do happen, I think that the demand for oil will remain intact, as we already can kind of see evidence of in some of our economic readings. Here's our economic surprise meter for all countries. And what this is showing you is that most of our currencies here are above 50%. All that's telling you, by the way, is that economic data is beating expectations for these places. For places like New Zealand, Australia, Switzerland, Canada, Europe, the UK, these places are seeing at least 50% on their economic surprise meters. By the way, as a Forex trader, I do use this as a gauge to determine which currencies look the most attractive to me based on economic data. So this would give us our top 3 scores: the UK or British pound, New Zealand, NZD, or Australia, AUD. And so I don't believe that the economies of the world are going to collapse. And I actually think that there's a good chance that the demand for oil remains steady. I think oil prices will rise, and I'm looking for a breakout in order to determine when I can actually enter the trade for a possible long setup. Going back to the currency side of things, I'm already long NZD JPY. I'll show you that trade. So I went long the New Zealand dollar at this level, and I have willingness to add to the position if we do go lower. It's a dollar cost averaging approach that I use in FX. And so I do think that we have room to continue to push higher. I'm also long the dollar yen. We can take a look at that one, which is performing less than attractive, right? Obviously, we're down here today. I went long around this area, so I'm in the red on this trade. And do think, however, that the Japanese yen should weaken from here. Part of the reason is take a look at our economic surprise meter for Japan, and you could see it is currently the weakest of the major currencies. And to extrapolate that out for the currency traders studying fundamentals, let's click on Japanese economic heat map right here. And what you can see is that most of our indicators that are on the fundamental analysis side of things, employment data, inflation data, growth data, most of these are suggesting some weakness for the Japanese economy, or for specifically the Japanese currency. So I do have a bearish overall outlook on the Japanese yen, which would suggest buying currency pairs like dollar yen, euro yen, pound yen, Aussie yen, Kiwi yen, etc., which is exactly what I've been personally doing with my UJ long and my NJ long currently. Obviously, this is not financial advice. I use a dollar cost averaging approach that is very low risk and tiny position sizing, and so I will add to these trades if I can get some better entry points. By the way, if you're interested in seeing all of the trades that I'm sharing each and every day, all of them get shared inside of our Discord server for VIP members. If you're not a VIP member and you'd like to see the trades that I take, yes, they get sent directly to your phone, to your desktop. You can see exactly where I'm entering trades, why I'm entering trades, where I'm exiting trades. I trade FX, commodities, indices, ETFs, stocks, and options, a little bit of everything. So we stay very active in here, and you can see trades from myself. You can also see Chris Pulver's trades if you sign up for that, Ivan's trades as well. And we do have a new person joining our roster pretty soon. Alan Perez, you may have heard of him. He's joining the team starting in June. Very exciting stuff to be sharing his trades as well as part of our VIP membership service. So check that out. If you have any questions, feel free to use the first link in the description down below to chat directly with our support team about the VIP memberships. Now, this is a signal service, but let me add a little bit of clarity around this. We share our trades with full transparency, full breakdowns, full analysis. First and foremost, this is an insights and educational service that we offer to members. So if that sounds like something that would benefit you, like I said, click the first link in the description down below to chat with our support team. Bitcoin is another one that I'm watching on the long side, but still a ways away from a good entry point for me personally. I'm looking at like 94,000. If we do get a correction from this recent up move, I'd be looking for possible long setups. And I do think it is likely that we see some new fresh all-time highs this year in Bitcoin, which by the way is not saying much considering how close we actually are. We added a new top setups page on the Edge Finder. What you can see here is it simplifies the score very simply down to our sentiment, technical, and economic data score overall within the Edge Finder. And you can see the strongest ones currently are things like the Dow Jones, the FTSE, the DAX, Bitcoin, US oil, the Russell, Platinum, NASDAQ, the dollar against the South African Rand, the dollar against the Japanese yen, S&P, pound Aussie, pound yen, and our bearish reading currently for the day right now is euro pound on the bearish side. And the way we use these scores is essentially, I showed you my oil idea. I'm still looking for a technical setup to align with this bias here before I take any trades. So it still requires you to do your own trading. And this is not a, plug and go kind of simple way to know what the market's going to do next. It's rather an analysis screener. It scans a whole bunch of data. And of course you can see the full breakdown, every single column on the top setups overall page. But for people who just want a quicker view of this gives me pretty much my watch list day in, day out automatically. Pound yen is also getting a bullish reading. I'm going to watch this one for possible entry points to add to my basket of yen short. And when it comes to indices, I am bullish on all of them. However, I really like the Dow Jones, and I'm going to watch this one close for some pullbacks. If it's this week or next week, we'll see if we get one. But I'd love to see, check out this relative outperformance, by the way. The Dow Jones is actually outperforming the rest of the crew here in terms of US indices today. So looking for pullbacks on this one. It's been stretched to the upside, I think, a little bit too much. So I'm not necessarily bearish on this one, but waiting to see if I can get a pullback before entering anything here on the long side. And today's video is sponsored by DNA Funded. If you haven't checked them out before and you're looking to get funded this year, check them out. They have a promo code with us that gets you 20% off any of their challenges, and they offer up to 90% profit sharing, and you can trade a very wide range of assets in their platform. They offer payouts in as low as 7 days, so check them out down below in the description to see if they're right for you, do your due diligence, and make sure to use that promo code for an extra discount on any of their challenges. The link for DNA Funded can be found in the description below. US debt is ginormous. In fact, you want to see something crazy? Check this out. US debt clock. You guys ever seen this before? This is a live feed of the US national debt. Take a look right here. See that? There it is. 36, almost 37 trillion dollars in national debt. And we're going to talk fundamentals on this and how this impacts everything going on. Interesting, they added this Doge clock. I've not seen that before. Interesting. Anyways, the Doge clock here, Department of Government Efficiency, the real-time savings objective from reducing government waste, fraud, and abuse in federal government agencies. Now, here's the thing, right? This is a problem. This is a huge problem. In fact, throughout history, debt and inflation are like the empire killers. If you study history, if you know your history, you know that to be true. Crippling debt, borrowing, and massive deficits, and these problems, I've heard about this since I was a kid. Clearly they take time because we've been in, massive debt in the United States as long as I can remember. In fact, there was, I think the last time the US balanced its debt was, is it the 70s or something? I don't. It might have been earlier than that. I don't know. Anybody have that stat for us? Let us know. I mean, says the U.S. are in debt. I'm pretty sure you're kidding, because, I mean, so let me ask you guys, this number, who are we in debt to? Do you know? Comment it really quick. Let me know. Drop it in the chat if you know. Who does the U.S. owe all this money to? Anybody know? China, says Amin. China, Japan, treasuries, China, mostly China, aliens. It's a good one. Mars. We owe it to Mars, guys. That's why Elon Musk wants to go there so bad. He wants to go to Mars so we can take back all that money we're sending them. So the biggest debt people that we owe debt to in the US. Who is it? Well, it may surprise you that yes, it is China. Yes, it is Japan. Yes, it is Europe. Yes, it is who am I missing? The UK. Who else? Name anybody. That's the point. That's the secret here. Name literally anyone in terms of a group of people, and there's about a 99.99% chance the US government owns money to them. Right? So the point is, everyone. Guess who really has a huge amount? The US Treasury. Wait a second, what? Wait a second. Wait. One of our biggest people that we've lent money to is ourselves. So listen, here's how it works. If you get started with the business opportunity and you recruit 2 friends into the business opportunity and they recruit 2 more friends into the business opportunity, then suddenly we have a triangle. It's not a pyramid scheme. It's just a triangle. Okay, get it right. Does this scare anybody else? This conversation always makes me uncomfortable. It is a bit of a Ponzi. However, unlike a Ponzi scheme is when it is literally just, it's all fraud. It's all like fake. The reality is the US economy, you can't, before you get all doomsday about the US national debt stuff, let's pause and think about something. The US economy is a real thing. It's a powerful force, right? We have, and it's not just, I know people say, well, yeah, it's a powerful force because we have the biggest military and we bully everyone. That's what, but at the end of the day, where do people want to invest money? The US. We have the best companies. We have Silicon Valley. We produce technology. We are the forefront of AI. We are the banking capital of the world, right? Which is kind of hilarious considering we're in so much debt. My point that I'm trying to get at with this is that, yes, everyone lends money to the US economy and there we have a giant amount of debt, but it's all okay as long as, first of all, we change the direction slowly. We can't just keep going in this direction. You keep going in this direction, the US will blow up. It's mathematically inevitable if we do not change the course of our debt situation. The other problem with this, the bigger the national debt gets, the more it costs for us to administer to that debt. Okay, so if you are somebody, and I know we're going to get into charts in a second, give me a second. If you're lending money out, right? We're the US and we're saying, this guy over here, we're giving him, we're gonna loan to him, and we're gonna lend to him, and we're gonna lend to this group over here. Everybody that we lend money or that lends us money wants it back and more. This is not, that's why people lend money to a government or to anybody. People lend the US money. People want their money back plus interest. That interest payment in the United States is getting ginormous, and it is getting to an unsustainable, it already is at an unsustainable path. You know who, and don't take my word for it because I'm just a guy on YouTube. Take Jerome Powell's word for it. Dude's a very smart man. Whether you like him or dislike him or whatever, he's a smart dude. He's not a dummy. Some people, I guess, would argue that he is, but I would argue that he's done a pretty decent job and he's a knowledgeable guy. And he actually had the the courage to say this in a big interview. He discussed at length that he thinks that we need to address the national debt sooner rather than later, and that it poses a big issue for the United States long term. So Moody's downgraded the US's credit rating. The US's credit rating was superb. Now it's slightly less than superb. Still good. Why? Why is the US easy to lend money to? Like I said, we have the best companies. We have a massive country of talent that gets purged from all the rest of the world. The US population grows largely due to people immigrating to the United States. If you took away immigration into the United States, guess what? We would probably be having a population growth issue like places like Japan and other places, right? Italy and things like that. We grow our economy because people want to come to the United States. They bring their talent. Immigration is a powerful force. It's a good thing. You know, don't let the headlines scare you. Immigration is a great thing, especially when it means talent coming to our country and bolstering up, improving our economy. Those are great things. It's what the American, dream is. Come to this country, bring your skill set, work hard. Again, people will say, "Oh, the American dream's dead. It's impossible." I would beg to differ. I think it is possible. It's not easy, but anyways, that's beside the point. Credit rating got downgraded, right? Makes people a little cautious about like, okay, well, do I want to lend government money? And if so, if you're going to lend the money to the US government, you know what people are saying? They're saying, okay, we'll lend you money. We'll lend the US national debt money. However, the rate that we want to get paid back, we want more. That's what bond investors in the United States are talking about. I often say that we spend all this time looking at gold and talking about the euro against the dollar and looking at everything else. But at the end of the day, arguably the most important chart that you could possibly look at, in my personal opinion, is the US 10-year Treasury yield chart. Okay? Because this is how much bond investors receive for lending their money to the US government per year. And where that chart is moving, where it is both on this scale and directionally moving, tells you so much about the fundamental story of the market. Look, the national debt is a huge problem. But it's been a huge problem, like I said, since I was a kid. And many of you guys might remember this as, my dad, we'd sit in the car and talk about this. He would educate me about this when I was 9 years old. And, it is true. We have to change it. However, the caveat here, the reason it's not an outright Ponzi scheme that's just all going to, end horribly, it depends on the US economy. Because if the economy is strong in the United States, then people feel more willing to feel stable about the debt that they're giving, right? If we are talking about, if I told you, hey, let's micro size this for a second. I come to your door and I say, hey, so-and-so, I need to borrow $20,000. Let's just say you had $20,000. Maybe you do, maybe you don't. And I say to you, hey, I need $20,000. Will you lend it to me? And how much will you, what do you want in interest? And you look and you say, well, what questions are you going to ask? Think about it for a second. If I ask to borrow $20,000 from you, what do you ask? You probably ask questions like, how are you going to use this money? You're going to ask me, how soon do you plan on paying this money back? You're going to ask, what's your credit rating? Like we just discussed, the US has a credit rating just like all of us individually do. It asks questions like, what's your income, right? How much are you making? How easy is this loan to repay for you? So the same thing happens on a big scale when we're talking about the US national debt. People say, how's the US economy looking? Well, that's what we do all day long in this show. That's what we talk about day in, day out. We talk about the US economy. And how are things looking? Well, a little bit concerning that we had GDP growth come in less than expected. That's our growth engine, right? If you're lending to a government, to a country, you want to see that their country is growing, right? If a country is shrinking, how do you expect them to pay you back? Of course, this is just one reading, and it can change, and economies don't move like this perfectly, right? They have periods of growth and decline, and growth and decline. And the idea is that a good country, like a good company, like a good individual, should overall trend higher. PMIs were better than expected, so outlook going forward is okay. But the point is that I want to get to is that the US economy is kind of mixed right now. Inflation's coming down. That's great. Inflation coming down is good, because what that means is the Fed can cut interest rates, lowering their duties on the debt that they already have. If you lower your borrowing costs, like if you borrow new money at lower rates to administer the old money that you've borrowed at higher interest rates, that reduces your duties or your interest payments. That's what the administration wants to do. So then people say, well, Nick, why doesn't Jerome Powell and team just cut interest rates right now, right? If inflation's here, why aren't they cutting interest rates right now? Well, here's the problem. Do you know that when the Fed began cutting interest rates, do you know what happened in the 10-year yield? You ready? This is a shocker. When the Fed began cutting interest rates last year, the bond market reversed yields. This is before they cut interest rates. Yields started going down. After they cut interest rates, yields started going up. That's not how that's supposed to work. And I'll tell you why. It's concerning. The bond market, the Fed cuts rates. Fed cuts, right? In theory, that should mean yields continue to go lower, because the bond market should say, hey, if the Fed's cutting rates, the baseline for how much lending out rates are going out to is going to drop. So everything should drop. Yields in general should be dropping. Why did it rise? The problem is that if the market believes, oh, the Fed is cutting too soon and inflation is not fully gone, if inflation expectations spike, so too does the 10-year yield. Because bond investors say, I'm not buying bonds. If there's going to be a lot of inflation, I don't want some 3%, 3.7%. I want 4%. I want 5%. That's what bond investors said. If inflation's going to be high, I need more on that coupon to make it worth my while. That is what the bond market said. So the bond market said, oh, Powell and team cut interest rates too soon. 10 years goes up. Bonds are boring. They're boring, but they're also the most important market in the whole thing. The whole marketplace. Bond market's the most important, in my opinion. Because the bond market tells you everything about the economy, the Fed, risk concerns. It tells the whole story. It's really powerful. So here's the problem, guys. 10-year still elevated here. The bond market doesn't quite see a huge drop in interest rates coming. I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.